Good afternoon, guys. Welcome to the mental session for today. We're going to talk about footprint charts today. There was quite a lot of demand last week for footprints. I'm going to go through the basic understanding. I'm going to show you the application. Note this is a very elementary session, okay? So I'm very much going through the basics. So if you know the basics of footprint, you might want to take a step aside. However, you might learn one or two things as we go along. So keep up. Okay, a footprint chart. Right. Relatively new tool. That's why I use it, that's why I like it. I found if you look at the history of tools, all right, you go back dating to the 80s, 90s when candlesticks were around, the patterns developed with candlestick patterns worked very well then. Why? Because it was a new phase. Everyone was utilizing the tool, there was sense that could be made of it. More importantly, strategies could be derived from it. Now, that was 35, 40 years ago. So what you have to say to yourself is, with all the theory, all the practical, all the data out there, have the strategies based on candlesticks not been a little bit overdone, overpopulated, saturated? Right? That's how I look at it. That's how I look at every strategy. All right. So I told you guys in the beginning, I'm going to teach you various principles. So principle number one, if something is obvious, it's obvious for everyone. Okay. If a strategy has been around for 20, 30 years and it's all over YouTube and every textbook you read, well, guess what? Everyone knows that strategy. So is there edge? And hopefully that's the first, okay, actually, that moving average crossover I keep reading about, right, maybe it's actually just a load of shit. Okay, that's the honest truth, guys. I always try and be very honest with you guys so that you can learn. Now, what I really like about footprints, it's been around for 5 years. The concept has been around for 5 years. However, it's not widely utilized or applied. Why? Because most people probably don't understand how to utilize it. And that comes, if you watch last week's mentored session, it was all about trading tools. And the whole session was based on the idea that the mistake we make as traders is we look at a tool for a strategy, right? And we reversed it last week. We said, well, actually, we have a strategy and we utilize the tool for the execution, for the application. All right? So strategy comes first. Then we utilize the tool. All right. Remember that. Okay, so let's get on to the topic here. All about footprints. I love footprints. Now, if I'm going to summarize, I did a webinar with IO Futures last week. If I'm going to summarize where footprint sits in the spectrum of leading versus lagging information, okay, it sits directly behind price. So what do I mean? You all know what a moving average is, okay? Moving average is a long way behind price. Why? Because it's an average of price, right? Whereas we have price being the most or the quickest piece of information. Why? Because it's exact, it's happening all the time. Just behind there we've got footprint, and that's why I love it, okay? Because for me, price is too quick. I'm not an algorithm, I'm not a computer, right? I don't say A plus B equals C. By that very nature, just paying attention to price is a bit too quick for me. Now, of course, you can develop strategies just utilizing price. That's what the price ladder course is all about. And you can utilize create very successful strategies just with the price ladder. Okay, for me as a trader, however, I'm a little bit more a position trader or whatever you want to call it. So ultimately, I need something that's a little bit slower. Now, what's lovely about a footprint is it's a summary. That's all it is, guys. It's a summary of what has occurred most recently. Whether I want to see that summary in 10 seconds format, 1 minute format, or rotational format. It is a summary. It's a beautiful summary. And it paints beautiful patterns that you can learn to interpret. Now, what I'm going to do with you today in the session is I'm going to show you what a footprint looks like. Okay, so let's bring it up. Let's make this a bit bigger. Right. Johnny, how do I get this bigger?
Control.
There we go. Okay, so what I've got up here for you, and I'm gonna actually just first go through the basics before I come back to the crux of it. Okay, can you all see that okay? That doesn't look very nice, does it? Can we get that nicer?
Probably the resolution once you've zoomed in.
Okay, let's get that not so nice. Let's go backwards a little bit. Johnny, can you sort of just make this out for me so I'm going to keep going? Okay, so the basic crux of it. Every one of these is a rotation. Don't worry about the numbers for now. All right? So every one of these little straight line up, straight line downs is a rotation. Now you can set those rotations. You can make it time-based, you can make it rotation-based. Right? The important thing to understand is that within each one of these rotations, there's information being summarized. Now, we look at that information as it's occurring and we develop various strategies. Okay, so just the basic understanding. Don't worry if a little bit of this goes over your head and you don't understand it all. That's not the purpose, right? It's to give you a little introduction. So, at every single price here, every one of these little rectangles, I'm going to draw on the side here. Every single one of these rectangles has got two numbers. So let's say 300 and 200, right? And it's got a little times in between. Now, what that's telling us is when we got to, let's call it price number 26. Someone at price number 26 sold 300 contracts, and at the same time, someone bought 200 contracts. Okay, so a buyer bought 26 contracts, but a seller sold 300 contracts. Now, we call this a footprint. It's like a scent. Someone leaves their smell all over the market. Now, what you want to learn to develop with the footprint is the interpretation of two concepts. One, initiative, and two, responsive behavior. Initiative is where someone takes the initiative. So a buyer steps into the market and he initiates a buy order through the market. So what would that typically look like? Well, let's say I'm a buyer, okay, and I step into this market. And I've got price 7, 8, 9, and 10 on the left, right? Now, there's a number of ways I can lift this. One, I can be super aggressive. And I can go lift the 7, lift the 8, lift the 9, lift the 10. Lift whatever's on the offer. And that'll look a little bit something like this on a footprint. You'll have a 0 times 200, maybe a 20 times 200. Sorry, I must write this all out for you. Maybe a 50 times 300, and maybe 100 times 300. Okay? So we can see as the buyer steps in and he starts to lift the prices 7, 8, 9, 10, right? He takes all the liquidity from the market. Yes, of course, there's a little bit of selling coming in at the same time, a little bit of algorithmic activity, whatever it may be. The important thing to interpret on a footprint is what we call the imbalance. Right, the imbalance is nothing more than the difference between, I was trying to use a fancy word there, the difference between what the buyer is doing and what the seller is doing. Okay, so you can see here, the difference on every price is that a buyer buys 200 and the seller sells nothing. On this price, a buyer buys 300 and the seller sells 20. On this price, a buyer buys 300 and the seller sells 50. Okay, so it creates an imbalance. So that's all you got to think of it. So the interaction, how is the buyer and seller interacting as price moves? That's what it is. That's what the footprint ultimately is. Okay, let's say it was slightly less aggressive. So price still goes up, so we can still see this bar moving up. But let's say it was slightly less aggressive. So let's say we had something like 200 times 200, or 300 times 400, or 250 times 180. Okay, so you can see the nature here now. There's a lot more two-way interaction between the buyers and sellers. That's the basic premise of what a footprint tells you. It tells you the interaction in a summarized format. Now, my question for you is, how is this useful? Why is this useful? How can we develop ultimately a strategy for success? And that's what today's session comes down to. So, in order for you to go away with some sort of a takeaway from today, some sort of a strategy, some sort of a, okay, I know what direction I want to go in with this idea of footprint. I've got a chart up. Okay, and I'm going to scroll to the top here, and I'm going to give you a few dates.
I think it was just the first one was a bit blurry.
They're all quite blurry, mate. Anyways, what you've got in front of you is the gold. Now, I like this chart because it's particularly good on the footprints. It looks particularly tidy on the footprints, but also because gold moves so bloody fast. I need something to summarize information for me. Okay, so again, straight away, the question I'm going to get is, can I use a footprint in this market? You can use a footprint in any market. You can use any tool in any market. Some tools tend to work slightly better. Why? Because a tool is nothing more than a tool. It's there to extract specific information. Okay, listen to me carefully. So a tool is there to extract specific information. So make sure when you put any tool on a chart, make sure you're putting it there not because you want to identify something, but because you want to extract information. Right? I have a moving average on my chart, on my volume. Why? Because I want to see what is the average volume over a period of time. So that if there's a big deviation from that volume, I can note it quite quickly. All right. Make sure when you add a tool, you're adding it for a specific purpose. So, you have the gold daily. Right? When you go away, I want you to go get this up. And there's 3 dates I want you to look at. The first date I want you to look at is this date over here. Okay, so again, apologies for this. It's not the nicest looking chart. Right? But you can see ultimately there's a downward sloping trend line in the gold. Right? So the first date I want you to go look at is that break point. And we're going to look at it as I go through the footprint. Okay, so it's the break point. And it comes, is there no way we can get a better chart of this, Johnny?
I think it was just the. Do you just do
I can't even see it on there. Okay?
Can you see here the top one's blurry?
Yeah.
But this second one down is better.
Okay.
See what I mean?
Okay.
So.
Okay. I'll scroll down. That's cool. We'll go through that
just
one.
look a bit blurry, but the other ones.
Okay.
Some look good. Some
Well, we'll use the middle one. That's fine.
This one?
Yeah.
Okay, that's better.
Okay. Apologies. So let's go back to that top screen, guys. So I can give you the dates. Then you can get this on your own time. Okay. So the first one I'm looking for is this break point over here. Right. It's the break of this triple top, long dated top on the market. Right. The second one that we're going to look at is this high that was made in the gold towards the end of August. I'll give you the exact dates in a minute. And then the third one we're going to look at is the very next day, the 29th of August, the accumulation. So we're going to look at 3 things. One, we're going to look at a top reversal being made. So we're going to look what a reversal looks like, the interaction looks like between buyers and sellers. The second strategy we're going to look at is a breakout strategy. And we're going to see the interaction again between buyers and sellers. And the third strategy we're going to look at is what we call accumulation on a footprint. Those are the 3 strategies I'm going to show you on the gold. So the first one, write this date down, please. All right, the first date is the, I can't even see the date on here.
28th, I think, of August.
26th of August. Okay, so the 26th of August is where we made a top at 1305.9 or 1306.9. You can go look at it. Now, if you go and get this footprint up, you're going to notice a number of things at how we made that top. The first thing is you're going to see quite a big surge in volume and delta and repricing in the market. So initiative comes in, buyers become quite aggressive, and they take the market bid up. How do we know that? Well, one, we can see a very big shift in the volatility. Okay, so if one of these auctions, remember every one of these is an auction rotation, if they were averaging say 10 ticks and suddenly we just see an auction rotation of 40 ticks, we can see that initiative is occurring. Right? We can confirm that obviously with a pickup in the volume as well as the delta. Okay, the market then gets to this price 1306 and suddenly the market just finds a little bit of sell side action. Now note, at no point am I ever going to say it's a sell here, it's a buy here. I'm noting the interaction that's occurring in hope that there's something that sticks out. Okay, this is the mistake a lot of you are going to make. You're going to go away, you're going to start looking at footprints and suddenly you're going to start trading off them. No. Right? You are looking to create or utilize the tool, find something very specific that sticks out, and I'll show you what the specific looks like in a minute, and then you want to execute off it. Right? So, the market then, and remember each one of these is 5 minutes. Okay, so that's a 5-minute rotation. The next 5 minutes you can see we extend and we top out. The following 5 minutes we form an inside candle. Okay, and then the next 5 minutes the market starts to auction a little bit lower. A little bit of profit taking, sellers coming in now, buyers stepping off the aggression gas. Now, at that same time, we can see a little bit of delta unwind, so we can see a little bit of profit take occurring. For me, as a trade strategy, right, at important tops and bottoms, now it's potential resistance and support, I do not sell it on the way up. Why? That's a mug's game. Okay, that's a kid's game. That's never going to work for you guys, right? What you want to look at in any trade strategy is that point where you can manage risk. Right, so the moment you know exactly where a stop goes, you have a strategy in place. So, based on this strategy, I would have been looking for the first retest, and unfortunately you can't quite see this, but there was a very large amount of two-way absorption that took place inside of this 5-minute rotation. In other words, the buyers and sellers were battling it out. Think about the logic. Price has just moved up aggressively. There's obviously quite a few shorts caught, but there's equally maybe someone that wants to get long. Okay, so in order for shorts to get out, they need to buy, and anyone who needs to get long, they need to buy. Equally, we have a bout of profit taking. So we've got a lot of different participants all partaking. Eventually, we can see the sellers win this battle. Why? Because price went down. In other words, there was more selling entering or more profit taking entering than those wanting to get out of shorts or get into longs. Okay, so what ultimately then happens? The market rotated lower. It came back a second time, ticked that point in the market before then rotating, not just for the rest of the session, but also the next day. It was that bit of absorption I was interested in terms of the short. Simple trade. I look for the short. Where's the stop? Should we be taking out the high point of this candle? No. Why? Because the sellers dominated in that area. So if the sellers are still quite strong, they shouldn't be overwhelmed above that price. If they are, yes, okay, maybe the market double tops. Maybe it does a one tick extension and then turns over. Now that's fine. Okay, but for me, I've identified strong selling. By that very nature, I stop out when the strong selling is no longer existent. Stop, call it 4 ticks, target. Not too concerned about that. That's not the importance here. Okay, that's our first strategy. Let's have a look at a second one. Now hopefully we can see this a bit better as well. Okay, so this is the breakout. That same area I just showed you, 1306, okay, or 1305.9. That same area, there it is there. So it's 1306.9, sorry. Let's have a look now what a traditional breakout looks like. So, as you can see, we've got all the bids on the left side, we've got all the offers on the right side. That's volume, obviously traded and on the bid and offer. Now note, in this example, as the market approaches that 1306, look at what occurs between the prices of 06 and 7.5. So within a range of 16 prices in the gold. All we see is a whole bunch of zeros on the left and numbers on the right. So what does that tell us between the interaction between a buyer and a seller? Okay, as prices come through these prices, we've only seen a buyer, not a single seller. Now when you see a whole bunch of zeros, it's something we call stops. In other words, someone has stopped out of their trade. How do we know that? Well, because when someone buys, let's say 3,000 contracts, he will get filled on every single offer, or he'll take every bit of liquidity on the offer until that position is executed. In other words, there is no opportunity for someone to sell. So we call that stops. Someone stopped out of their position. Now, what do we want to see in a breakout? What's the ultimate purpose of a breakout? It's called a breakout for a reason. We want to break out. We want to move out of range. So what sort of response should we see from buyers and sellers? Aggressive, initiative, powerful, no two-way trade. Now you want to become a good breakout trader. Footprints are wonderful for this because you know what you need to see. 1, you want to see stops. 2, you want to see aggression. 3, you want to see power. 4, you don't want to see any counter. You don't want to see a seller step in. Okay? So let's see what happens. The market goes bid quite aggressively. Now note, the market runs into liquidity, and we can see that because look at the offers being filled. Now this is an important thing, and most people get this wrong, and they seem to think that just because someone's getting filled, that means someone's selling. Okay? Yes, someone is selling, but that does not necessarily mean price is going down. Okay? As much as someone is selling 500, 400, and which is a lot of volume, by the way, as much as someone is selling all of this, guess what? Someone's buying it at higher and higher prices, and that's the key. Right? Always think about that. The more volume, the more business someone's willing to transact at more extreme prices is telling you the more extreme nature of the potential for that move. Okay, and this is where you kind of got to almost put yourself in a different mindset. When you see that sort of price response, the initiative thought is, oh, I'll wait for a pullback. Okay. Heck no. If you wait for a pullback, you're never going to get filled because guess what? This guy's doing so much volume at the extreme prices that he's probably going to keep going. Why? Because he's got more to do. That's the key. Now, the beautiful part about this is a good lesson to learn from this. As traders, we tend to enforce a lot of subjectivity on the market, our opinions, our ideas, and we move away from the facts. And that's why Footprint is so beautiful, because all it's showing me as facts. Okay, there's a stop out. There is a lot of volume being transacted, of a lot of liquidity, a lot of volume, a lot of delta, but a buyer is buying so aggressively. It's all fact. It's not my opinion. I can see it right there. Okay, so by that very nature, if I look at the facts, yes, this should keep going up. If I look at my opinion, oh, there might be a resistance line here, or maybe it's gone too far too fast, or maybe, it's moving too quickly. Can you see the difference? You stick to the facts, you've got a strategy. You stick to your opinion, right? You can guess what's going to happen, right? Inconsistency. It's not to say you can't make money with your opinion. Of course you can. But are you going to be consistent? No. If you identify this on every single breakout for the next, 10 breakouts across 10 markets, do you think you will be successful in executing a very basic strategy? 100% yes. That's the art of the footprint. Find a strategy. Find something that works. And you're going to see this a lot on breakouts. You're going to see the stops. Then you're going to see the heavy liquidity trade. That heavy liquidity trade is not a reason for you to get out. If anything, it's a reason for you to stay in so long as that aggressiveness remains. Because guess what? Once those sellers stop providing liquidity and that buyer says, well, I still got more to come, where's price going to go? Up the page. Okay, that's our second example. Our third and last example. Again, this is the 29th of August. Now, this is one of my favorite plays. I love this play. When you see a breakout, don't fade. Never fade a breakout. When there's that sort of power, that sort of initiative, don't fade it. Don't even entertain the fade. Stay with the trend, stay with initiative, or stay the hell out and go play somewhere else. Good rule of thumb. Now, day 2 after a breakout. I love day 2 after a breakout. Okay? What is everyone looking to do? So let's draw the candle. Let's draw this big fat green candle. There's our big fat green candle. We just broke out of this area called 13, 20, I don't even know the price now. Okay? So we've broken out of this level. What is everyone looking to do? Everyone's looking to be long. Okay? It's as simple as that. We don't have to think about it, we don't have to argue about it. Everyone is looking to be long. Why? The net positioning in the market is now long. The initiative is in the market, which means there's short-term long positioning, okay? And there's potentially short court. So there's a lot of reasons to be long the market. Now that's the first thing to know, because if everyone wants to be long the market, price, by that very definition, should not be able to go lower very easily. Why? Because there's very few people willing to sell the market. So the first thing you're going to say to yourself is, how deep can the pullback potentially be? Okay? The second thing you have to say to yourself is, what sort of price response would you expect to see? What sort of interaction between buyers and sellers would you expect to see if everyone wants to be long? And I'm going to draw it for you. It looks a little bit like this. So this is the previous day's high. We get a little bit of noise, a little bit of algorithms. What is their job? And market makers' job is to facilitate trade. So they have to find a buyer. Okay? So they're going to keep selling it until they run into what? Liquidity or a buyer. And the minute they run into a buyer, what's going to happen? One of two things. That buyer is either going to snap, he's going to be aggressive, and he's going to take a straight bid. Why? Because price is favorable, it's at a discount, and he needs to start getting some work done. Or he'll be a little more passive and he'll respond to the low price and try and execute as best he can, in which case you'll get a little bit of something like this. So you'll get the drift, and then you'll get the absorption, and then you'll get the move up. Either way, we know with a high probability that day 2 after a breakout, you're going to get some form of a bid up. So you're looking for something very specific again on the footprint. Not made up, not the opinion. You're looking for buy-side interaction. You're looking for that point where those noisy algorithms or profit taking stop selling and the buyer becomes either aggressive or he starts to build a position. That's all you're looking for. Nothing else. Simple as that. What does it look like on a footprint? Again, you can go and get this up. You will notice in this instance, when the market got to the 1320 and a half, it got very quickly bid back up. In other words, the market came down, the algos ran into a buyer, the buyer took 4,500 contracts of gold, and not only did he take those contracts of gold, he said, okay, well shit, I've been identified, I need to start getting the rest of this done. And what did he do? He took the market back up, and for the rest of the day, the gold rallied, and we took out the previous day's highs. Simple accumulation. You can go and look at how that broke down in the footprint chart. That's the conclusion, guys. The footprint is nothing more than a summary of what's occurring on the price ladder. The price ladder is unique. It's a very specific tool, own strategies, own ways of getting better at it. The footprint is nothing more than a tool. It provides me with information to make decisions on what? On a strategy I've already formulated, not the other way around. Okay, not I've got a footprint, let me find a strategy. Right? You've got a strategy. It's a breakout, a fade, whatever you want to call it. Call the strategy whatever you want. There's 1,001 of them. Utilize the tool for its definition, which is it is a summary tool. It summarizes information. Okay, I'm going to open the floor to the members on the group, and if any of you guys on the floor, whilst they're typing away, if any of you guys have got a question, yeah, shoot. See if the little arrow zoom tool down the bottom on the right hand side in the toolbar does anything. Might make the pick. Thanks, Sam, appreciate that. Okay, what I am going to say to you guys, ask your questions away. You've got those dates, okay? You can see the gold chart. Get the daily chart up. Go look at those 3 points. One was the breakout, the key breakout. The key high we made. The second was the breakout of that key high. And the third was the next day, okay? The breakout was the 28th of August. The retest and the absorption was the 29th of August this year. Right? Go look at the footprint. Go look at the interaction. Okay. Do you guys have any questions? I know this footprint is... it's not a tool I would typically teach someone first. Okay, it's a little bit advanced. It's probably easier to understand the footprint if you understand the price ladder. Right? For me, they go hand in hand. If you know the price ladder, you have to know the footprint. Okay, but then equally, I would say you have to know the profiles as well. So again, if anyone asks me what am I proficient in terms of tools, well, I'd say market profile. Obviously the footprint charts as well as obviously the price ladder. Yes, okay, I'm good at candlesticks, but do I know a shooting star from a doji no, probably not. Okay, do I know every candlestick pattern on the earth? No, I don't. Right? Why? Well, because I prefer other tools to extract information for my strategies.
You know the turning point you showed us at the bottom?
Yeah.
So if buyers were willing to step in the market there, and then obviously that's like a key support resistance level in the future. Is that how you'd see it? So if they're going to hold and defend it again?
I like that. That's a great question. Okay. So I'll draw that. I remember what it looked like because I was quite annoyed. It happened at 1:45 a.m. in the morning, which means I couldn't get in it. So this is what it looked like. I'm going to draw it for you. So the market came down and it ran into something like this, 140 by 60, 80 by 20, and it was something like that, 115 by 20. So it came in, so it was very thin. It came down. There was nothing really transacting at 1:50 in the morning when typically we're doing maybe 100, 200 contracts every 5 minutes. And suddenly it just runs into 1,500 contracts. Duh. Okay. Straight away, someone has just taken as many as they could. In other words, someone's selling and someone just sat there going, I'll have, keep selling. And the minute the selling stopped, what did he do? The buyer not only took as many as he could, but he realized, well, I've got to start lifting offers again. And that's why when it goes back bid up, you'll see it almost thins out. So you'll see very little is sold into the bid, but quite a lot is lifted. And that was the interaction. So yes, the most important thing is that leaves a cent. Someone bought it there. That's a buyer. That's a key area. Not because it's a line on a chart. Okay, it's a key area because we can see a buyer accumulated there. That's where he got his job done. That's where he got the business done. Now, it's not to say the next time that it'll come there that he's there. That's the mistake people make. Okay, he might not be there. If that had come back later on in the day and tested it, yes, I probably would have been buying it. Why? Because that very next day, you can't tell me that there's not still buying interest the day after. Contextually, there should definitely still be buying interest down there. Okay, so yes, I would have been buying it there the second day. It's definitely support. Right, let's see if there's any questions.
Could you use it to, I'm probably just brain spieling here, but if you're saying, obviously you can use that and work out the delta. If you identify a range and that delta starts increasing, would you be able to use this to foresee a breakout to either side?
Now you're thinking. Okay. Let me propose the question to you this way. This is a key line. It's resistance. Everyone can see it on a chart.
Yeah.
Right? A number of breakouts. Breakouts occur in different ways. Sometimes they stop break. Sometimes they slow grindy accumulation breaks. Sometimes there's initiation. Sometimes they're not always straightforward. It's not always just bang, okay, breakout, I made lots of money again. It differs. The important thing to understand is what occurs before the break. Right? A lot of the time, good breakouts, there's no defense. And there shouldn't be. Okay, a good breakout, everyone should be on the same side. Okay, when I mean the same side and everyone, I mean institutions, big players, hedge funds, algorithms, day traders. We should all be on the same side in a breakout. If we're not, that's what creates the two-way trade. Okay, so what you want to watch as you approach this area is, what is the interaction like? Yes, sometimes it's going to be quick and fast and free money. Sometimes it's going to be cumbersome and there's going to be a lot of two-way trade. So you need to learn to identify the difference between the two. Both of them on a daily candle might look like, oh, we broke out today. And everyone will go, oh, but it was so easy, you just had to buy it. It doesn't always work like that. The real art is knowing the difference. The real art is if you can identify when, oh, we're about to break this and there's not a seller in sight. The real art is being able to leverage up when you can see that, when it's occurring like you think it should occur. Someone asked me today, and this is where I'm going to finish off, someone asked me about how to employ leverage. Well, it's simple. You employ leverage when you've seen something work 1,000 times, right? Because if it's worked 1,000 times and you see exactly what you want to see, yes, the probability of outcome still remains what it is every time, 60, 70, whatever you want to call it, percent, right? But the mere fact that you've identified and you interpret the risk and you know the risk, you take it full on every single time, right? Because over time, you're going to make good money. Right, so hopefully that answers your question. The footprint is a tool, it's an art form. It's not an exact science. Sometimes it is. When I do my daily debrief every day and I take snapshots, I look at it and I go, oh, they're so clean, so easy. I should have made so much money. Okay, but sometimes it isn't. Sometimes you go look at Sterling yesterday. Sterling had a very good breakout. Had a very nice, interesting breakout. It was horrible if you were breaking out, doing a quick strategy. But there was a lot of accumulation. There was a lot of build. There was a lot of pressure, and the buyers just kept holding and holding and holding. And it was beautiful in its own way. Not easy, beautiful. Okay, and that's all the footprint is. It's something you look at every day and you observe it and you see how the buyers and sellers interact, and you then learn to apply that interaction to your strategies. Okay. All right, guys. Have a good afternoon, and yeah, we'll catch up again next week.
Cheers.